Investors are naturally concerned about where we are in the global economic and financial cycle. This is the second longest economic expansion in U.S. history, and we've had a bull market in stocks for the past 9 years. Does this mean that the market is going to take a plunge, or that the economic cycle is going to come to an end in the near future? Not necessarily. When we look back on the 2015-2016 period, the global economy experienced something like a recession. We had a very severe downturn in China related to property development and manufacturing. We had a decline in energy prices that led to a collapse in energy development spending, both in the United States and globally. We also had a downturn in emerging markets related to the decline in commodity prices and related development. So if you add all of this up, what you find is that global industrial orders fell for 15 consecutive months. This is something that's never been observed outside of an official recession. We also saw a 20% decline in corporate profits in the United States. Again, something that's never been observed outside of an official recession. If we look at our industrial order books today, they're about 8% below where one would expect them to be based on a continuation of the 2010 to 2014 trend. So there's actually a lot more room for growth than many people might expect, and in many ways, that 2015-2016 quasi-recession actually reset the clock on the current expansion, which could last a lot longer than many people suspect. At this point in the cycle, investors should focus on three things. First, keep investing. We don't know how long the cycle is going to last. A number of indicators we look at suggest it could last a lot longer than many people think. Secondly, investors should increase exposure to idiosyncratic or uncorrelated risks. In the corporate private equity context, that means carve-outs. It means investments that have lots of execution risk. And execution risk is unrelated to what the global economy is doing. It's unrelated to what global stock markets are doing that day, that month, that year. And thirdly, investors should increase exposure to those sectors that are actually likely to perform well in the event of higher inflation and higher interest rates. And that's energy and financial services. Energy prices are very highly correlated with inflation expectations. They're co-determined by the same aggregate demand factors. So if investors focus on these three things, I think their portfolio is going to perform well no matter what the next few years have in store.